Have you ever wondered how people actually build wealth? Not just earning a paycheck, but making their money work for them? Well, for most people, the answer is investing. It's a word that gets thrown around all the time, but what does it really mean? And more importantly, how does it all work? Let's get into it and break it all down. So, here's our game plan. We're going to start from square one, what investing even is. Then we'll look at the two big players, stocks and bonds. After that, we'll see how money actually gets into the system, uncover the secret sauce that makes it all grow, and we'll wrap up with two super simple rules to set you up for success.
All right, first things first. When we talk about investing, what are we really doing? Let's start with a really clear definition.
At its heart, investing is really just a trade-off. It's the decision to not spend a dollar today and instead put that dollar to work. And the goal? Well, the goal is for that dollar to grow into more than a dollar in the future. It's all about using what you have, your assets, to hopefully earn more money down the road. Okay, so you've decided to invest. Where does your money go? For most people, it's going to fall into one of two main buckets, stocks and bonds. And understanding the difference between these two is absolutely key. Let's kick things off with stocks. When you buy a stock, or a share, you'll hear it called, you are literally buying a tiny, tiny piece of a company. You become a part owner. It's that simple. And if that company does well, you do well. So how does owning that tiny piece actually make you money? Well, there are two main ways. First up, dividends. This is when a company makes a profit and decides to share a piece of it directly with its owners. That's you. The second way is through capital gains. This is the one most people think of. You buy a stock, its price goes up, and you sell it for more than you paid. And this right here gets to the core difference between stocks and bonds. A stock is ownership. A bond is a loan. As an owner, you're taking on more risk. The company might not do well, but you also get a shot at much higher rewards. Bonds, on the other hand, since they're just loans, are generally the safer, more predictable option of the two. The easiest way to think about a bond is like an IOU. You are lending your money to a big company or even the government. In return, they promise to pay you back the full amount plus some interest on a specific date in the future. It's a much more stable and predictable kind of investment. So every bond has three basic parts. You've got the coupon rate, that's just the interest rate you'll get paid. Then there's the maturity, that's the date you get your original investment back. And finally, the par value, which is that original amount of the loan you get back when it's all said and done. Okay, so we've got stocks, we've got bonds. But how does a regular person like you or me actually get them? It's not like you can just walk into Apple's headquarters and ask to buy a share, right? That's where these things called financial intermediaries come into play. They're the connectors. These are the big institutions that help move all this money around. You're definitely familiar with banks, but when it comes to investing, players like mutual funds and pension funds are incredibly important. Let's really zero in on mutual funds for a second because they are an amazing tool, especially for beginners. Think of a mutual fund like a big investment potluck. Everybody throws their money into the same pot, then a professional manager takes that giant pool of cash and invests it in tons of different stocks and bonds. For you, it means you get instant variety without having to go out and buy hundreds of different things yourself. It's pretty cool. But how does a small amount of money actually become a large amount of money? Well, that brings us to what might be the most powerful force in finance. Some have even called it the eighth wonder of the world. It's the real engine behind long-term growth, and it's called compounding. So, the whole secret here is understanding simple versus compound interest. With simple interest, you only ever earn interest on the money you first put in. But with compound interest, that's where the magic happens. You start earning interest on your interest. Just look at this chart. We've got the same $10,000 invested for the same 5 years at the same 5%. But compounding earns you over $300 more. Now, I know what you're thinking. That doesn't sound like a fortune. But imagine that difference stretched out over 20, 30, or 40 years. That little gap becomes a massive canyon of extra wealth. Honestly, this is the best way to think about it right here. It's a snowball effect. Your money starts earning its own money. Then, that money starts earning its own money. It's just a beautiful wealth-building cycle that gets bigger and bigger over time. Okay, so now that we know all of this, what should you actually do? Well, believe it or not, it all kind of boils down to two incredibly simple but really powerful rules for success. Rule number one, diversify. It's the old saying, don't put all your eggs in one basket.
By spreading your money across a bunch of different investments, you lower your risk if any single one of them doesn't do so well. And rule number 2, start as early as you can. Because of that compounding magic we just talked about, time is without a doubt your greatest asset. The more time your money has to grow, the more powerful that snowball effect becomes.
And that really leaves us with just one last thing to think about. We've seen that the single most important factor for success isn't about picking the one perfect stock. And it's not even about how much money you start with. It's time. So the only real question left is, when are you going to start putting your greatest asset to work?